An investor that chooses a 60/40 portfolio is an investor that doesn't want full equity risk, right? By design. But the way they're going about hedging their downside equity market risk or reducing volatility is making one very large bet that's completely dependent on bonds. And so it's in my view kind of an insufficient diversification for this defensive sleeve of your portfolio. There are other things that you can add into the portfolio that also have low correlation to equities, that also have defensive, lower volatility profiles than equities, that also are uncorrelated to bonds. So that you really should be thinking about a portfolio that's stocks, bonds, and then other sources of diversification. So you're not so dependent on bonds with inside of a 60/40 portfolio.
Does trend following work on stocks? That is the question I'm asking today to Longboard Asset Management's Cole Wilcox. Cole, how you doing, man?
Good, how are you?
Doing pretty good. So Longboard, you guys are big into trend following. You guys like that strategy, so do I. We also do trend following. My question to you, just want to start off, what is it about trend following that you enjoy so much? Why is that your preferred pill?
I think for us, we're very defensive, risk-aware investors who believe in diversification, and we see trend following as being one of the most effective ways to preserve capital in bad markets, to offer a non-correlated investment that can diversify portfolios and just be an effective risk reducer and diversifier to your equity portfolio. We also like it because it's very disciplined and rules-based in nature, and that kind of speaks to our philosophy and personalities to be very disciplined.
How did you first hear about trend following? What was how did you fall in love with that strategy?
Well, the hard way. I started my career in 1997. So initially I saw a boom and then a bust, and then a boom and then another bust in a 5-year window of time. And so kind of seeing people do well and then seeing them get completely destroyed and the emotional ups and downs that came along with that kind of led me to, there's got to be a better way of investing, and there's got to be a better way to kind of smooth out this boom bust cycle. And naturally that kind of gravitated towards looking into risk management strategies, looking into defensive strategies. Trend following kind of is something that, as I started doing research, bubbled up as being one of the long-term most effective ways of navigating, difficult market environments while still producing attractive rates of return, and was just an excellent defensive investment to complement a team of investments and build a diverse portfolio. I also liked it because you could back test it and have a lot of data going back to give you more confidence in the effectiveness of the strategy through multiple cycles beyond just your own personal investment experience. And that's kind of how I came about, why I'd gravitated towards trend following was just a very early career personal experiences of boom bust and seeking a better way of investing.
Yeah. And, when it comes to trend following, a lot of research has been done, especially in the future side. So generally people refer to this as managed futures trend. Some people do long flat, just or maybe implement momentum across different asset classes. Your research, specifically the research we're going to talk about, is it's a little bit different. You're actually looking at trend following within the stock market, selecting individual stocks, and then using trend following to kind of ride those waves. So you wrote this paper in 2005 and then updated it 20 years later. And that's the paper we want to talk about. For viewers, I recommend you give this a read. A very interesting research, definitely worth the read. So I want to get to the nitty-gritty of the strategy and kind of just hear your thoughts about how you're building this strategy that you're in your research paper. So you select stocks that are an all-time high as the entry signal. This is quite a little bit different from what other managers do. They usually use either channel breakouts or moving averages. So my question to you is, what is it about an all-time high that triggers that buy signal?
Well, I think it's simplicity, more than anything. Buying a new all-time high or buying a multi-year high is a breakout strategy. So whether or not you're using a moving average breakout or a channel breakout, I mean, a 3-year high or a new all-time high is really just a breakout over some defined previous box of time. In the case of a new all-time high, it's the full box of the look back of the data. But it's just a very simple way of running a breakout strategy that's very objective. It's like a new high, a new all-time high. Every trend following indicator with the new all-time high is going to be long a position. There's not going to be any argument about whether or not it's a positive trend or not a positive trend.
Do you find that using that signal is better specified to stocks, or is that something you could use in different asset classes? Would you run a managed future strategy doing that, or is that specific to stocks?
It's specific to stocks. I mean, individual stocks have a very different distribution than futures do. Like as an example, I mean, equities are a kind of call option, like a long-term call option on the long-term cash flows, of a business or the value creation of a business, and sort of it's a perpetual equity type, positions. Whereas, so they can go on for many years or decades in these persistent, trends that represent the fundamental growth of a business or failure of a business. Futures, it's a contract for a very specific, period of time, and then it ends, and then you got to move into the next contract. They're also very different markets. Futures markets are risk transfer markets. They're designed for hedgers to offload risk to somebody else. Whereas individual equities are more capital formation marketplaces and represent ownership of tangible assets. And whereas futures don't represent direct ownership of tangible assets. So they're just very, very different. In our approach, we're trying to apply trend following, but not from a trading standpoint. We're not trying to get in and get out and ride short-term momentum. We're trying to use trend following as a mechanism to be very good long-term investors in equities. And then also, more importantly, to play very good defense. I would argue there's a lot of great ways to be a good investor in equities. I mean, you could just be a basic passive indexed investor and get great results. In fact, your results as being an index investor is probably going to be better than your average active manager. Certainly the data shows that net of fees. But that's just on the return side. On the defensive side, these active strategies or trend following can be very, very good and much better than passive investing in equities on controlling drawdowns, reducing the risk, and just creating a better emotional ride of smoother volatility relative to just being a passive investor. So even if they don't generate the same rates of return or similar rates of return, the real benefit is on the defensive nature, the diversification nature, and the smoother emotional ride of investing this way. So we are not, I think your typical multi-asset trend follower, kind of as you think of trend following, is, I would call it shorter duration or intermediate term duration trends, where trying to capture somewhere between, a month to a year on the very, very long end, of stuff. And they tend to be pretty sensitive to changes in directional trend. Whereas we are trying to be very good long-term investors and the biggest winners in individual stocks. We're looking to own the next 10 bagger or 50 bagger. And those kinds of trends play out over multiple years. They don't play out over multiple days or quarters or months. So it's more of an investment philosophy and discipline and approach that sets us apart from being very different than kind of traders who are applying trend following to much shorter duration instruments and are not truly investors in the underlying assets that they own.
So let me ask this question. One of the best charts in the paper shows the distribution of returns. And like most trend following strategies, this shows that 7% of trades account for the entire profitability of the strategy, and it exhibits huge positive skew. That just goes to show the power of trend following. That is part of the reason people like it. It's counterintuitive that it loses most of the time, but then every now and then it really does shine. So in light of that, and kind of just talking about portfolio construction here, how can trend best be applied at the portfolio level? Is this best viewed as a diversifier? Is it a core position? What do you think? How do you think investors should think about trend following within their portfolios?
Well, I think in your typical investor is approaching investing in traditional assets of stocks and bonds, right? Stocks are the offensive. I'm going to get the best returns from an equity portfolio, but they're obviously 100% stock portfolio is very risky. And so they complement it with bonds in order to reduce the volatility. And maybe bonds are not perfectly correlated to stocks, so you get some diversification benefit. But they definitely reduce volatility. And you smooth out the return, and you get the two. So I would put stocks kind of in the offensive category of portfolio construction and bonds in the defensive bucket of things. Alternative strategies like trend following and other liquid alternative approaches are definitely in that defensive bucket. They are designed to be a source of diversification. They're designed to preserve capital in bad markets, to reduce volatility, and to reduce the maximum drawdowns and the downside risks that bad equity market cycles can create, which helps do two things. One, improve the investor experience by keeping you staying invested and not kind of freaking out when the market's down or changing your plan. And also just to the math of compounding, that if you don't go down 50%, if you go down 50%, you have to make 100% return just to get back to break even. If you play better defense in down markets, you're coming from a higher base at which you start the next bull market cycle. And that has a huge impact. Reducing volatility and reducing drawdowns has a huge impact on your long-term compounded annual growth rate versus a very high volatility investment. So trend following as a mechanism or as a strategy is very good at playing defense. It's a great defensive player. That's where it belongs in the portfolio, and is a great tool for kind of complementing your traditional assets for that role. But there are some defensive positions, and you also, there's two sides of the game, right? You have to defend, but you also have to not be a drag on the offense, right? If I put you on the in the game and you can't score at all, and all you can do is play defense, you're adding value, but there is a cost associated with it, which is you're not scoring. So that's where, in a trend following standpoint, you're trying to design strategies that can kind of optimize for a highly effective defense, but at the same time not being a drag on the performance. And I think that's where, at least in our case, that's where our process is, and our choices about portfolio construction and our choices to do trend following on stocks is kind of different relative to your typical multi-asset strategy. Like trend following on stocks that's in the paper, and that kind of approach has historically had more than 3x the return that you would have received from a multi-asset trend approach. And in the last decade has had similar or slightly less max drawdowns than what you get from a multi-asset trend approach. So now, and it still has great defensive properties and is going to control drawdowns and be a great diversifier. Is trend on stocks as uncorrelated and as good of a defensive player in a market crisis? Like, is it going to produce positive returns in 2022? No. Does it have slightly higher correlation to the stock market? Yes, relative to multi-asset trend. That the multi-asset trend is very great on lower average correlation and potentially having positive returns once a decade. but it comes at a cost, right? It's not very good at keeping pace with the market and can create a lot of kind of opportunity cost, performance drag when you're not going through a crisis. So it's really about, when you're constructing trend strategies, it's really about the balance and the trade-offs, right? Like, are you really, really needing low correlation, but that's going to come with highly inconsistent and erratic returns that ultimately be low? Or can you tolerate, or would you prefer more of like a moderate correlation approach that had like bond-like correlation to equities, but had maybe 3x the return of what you received from multi-asset trend, and on average you were a lot happier with that kind of investment experience and suffered less tracking error or kind of FOMO of your performance of your diversifier defensive strategy compared to what you were getting in equities. And I think that's where it comes down to, is like the devil's in the detail. There's a lot of ways of doing trend, and it's just about what are your priorities, and that is what should then drive what kind of trend portfolio you should construct, whether or not you should be preferring multi-asset trend, or would you preferring something that's more of a equity, trend kind of component. There isn't a right answer of a one size fits all thing for investors. It's really about what are your priorities, what are your needs, and then kind of going in the direction that best fits what you're trying to accomplish.
So a typical investor, let's just say a 60-40 investor, it seems like in the world of finance, 60-40 is just the go-to, and it's been established as the typical investor. But for someone like that, what would you say? Trend following is not really an exposure that most people have. I think that would be a fair statement to say. To take a 60-40 portfolio, what would you think a typical investor would benefit? Like, what weighting would you give to trend following to really start seeing some of those benefits? And does that differ for something like a stock only trend following program versus something like multi-asset futures?
Yeah. Well, I think it depends on the investor. So your typical 60-40 portfolio is getting most of its return is coming from the equity side of it, and then it's using the bond part to reduce volatility. So we're talking about an investor that chooses a 60-40 portfolio is an investor that doesn't want full equity risk, right? By design. But the way they're going about hedging their downside equity market risk or reducing volatility is making one very large bet that's completely dependent on bonds and the correlation properties of bonds, the volatility properties of bonds, and the return properties of bonds. And so it's in my view kind of an insufficient diversification for this defensive sleeve of your portfolio. There are other things that you can add into the portfolio that also have low correlation to equities, that also have defensive, lower volatility profiles than equities, that also are uncorrelated to bonds. So that you really should be thinking about a portfolio that's stocks, bonds, and then other sources of diversification. So you're not so dependent on bonds inside of a 60-40 portfolio. I think by and large, the vast majority of investors are completely reliant on bonds to be their sole source of diversification. And I just don't think that is the most robust way of kind of building a durable portfolio that can kind of survive all market environments. There's certainly environments that have happened historically where stocks and bonds can fall at the same time and have large losses and create a lot more risk and a lot lower returns than maybe what people would be expecting from that 60-40 portfolio.
What are your thoughts on this industry trend that's picking up of utilizing futures or managed futures or trend, but using them in a capital efficient manner? And that looks like two different things. Sometimes the collateral differs. So instead of using T-bills, you would use something like bonds or stocks. Or there's other alternatives that just up the volatility. What are your thoughts on those types of investments that seek to be more capital efficient? Is there any risk for investors looking at those line items. But what are your general thoughts on that?
Well, I mean, I think that anytime, when we start talking about capital efficiency, what we're really saying is leverage, right? Like we have a structure. In order to get the capital efficiency, we need to use leverage within inside of our portfolios. So I think that financial innovation is great, and creating efficiencies or ways to make more efficient capital allocation or make products more efficient for prospective investors to use is a good thing for sure. And I think that all good things taken to an extreme, however, right, could introduce unintended consequences or potential risks that people were, unaware of. So I think that one of the risks of taking, say, two asset classes like stocks and managed futures and blending them together, which a number of, products that exist in the market are doing, that as sort of a beta plus alpha trend strategy combined. They're very dependent. In order to have that be a low risk strategy, you're very dependent upon the historical correlation of stocks and multi-asset trend behaving in the future the way they have in the past, which is to generally be uncorrelated. But there's no fundamental law or rule that says they have to be uncorrelated. And there can be periods of time, and there has been periods of time where the correlation spike and go to 1 between those two strategies. And if you are using leverage or a lot of leverage in an effort to create a capital efficient product, and you have losses that are larger than historically seen and correlations that are higher than historically seen, you can then will end up getting losses in those types of products that are far beyond what people are probably expecting, that they're going to get. So I would just say, leverage is a tool that can be used for good or evil, and everything taken to an extreme can be quite risky. I think that investors really need to understand the actual true risks that they're taking and be realistic about those things. And when we hear capital efficiency, to remember that the way you get capital efficiency is through the form of leverage and derivatives, which then come with their own sets of risks, which may be appropriate or not appropriate. But I just think you have to do an extra level of due diligence and really thinking through the fastest way to lose all of your money. I think Charlie Munger had a quote, and it said that it was the 3 L's. A smart man can only, a smart person can only go broke with the 3 L's, right? Liquor, ladies, and leverage. And so leverage is the fastest of the 3 for sure. And so you just have to be, very aware of what you're buying, what's embedded into it. And I think that's very difficult for, the non-professionals, right? It's hard enough for professionals to understand what's going on, there. I mean, that's why we ended up having a global financial crisis, in 2008 is, derivatives on top of derivatives on top of derivatives at the bank level with, mortgages and collateralized obligations and, everything that you saw in the movie The Big Short. And it's not that easy to understand the true risks that you're taking in these products. So I would just say, kind of do your homework and, be realistic about the risks of using large amounts of leverage.
I wanted to ask you, some people view managed futures trend as crisis alpha. Now, we've talked about how it's a diversifier. It tends to do well during times when equities or buy and hold equities are not doing so well. But would you go as far as saying that it's crisis alpha, or do you view that as, hey, it could be, but not necessarily? Where do you stand on that?
I think, again, I say it could be, but not necessarily. Has it been a source of crisis alpha more often than not historically? Yes. Is the strategy designed to flip positions and go from long to short when there is a a reversal in markets, yes. So I think it's, reasonable to kind of think that the strategy is going to shift from here to here and can produce a form of crisis alpha. However, it is very path travel dependent. If the crisis is all of the markets are at new highs across commodities, currencies, equities, fixed income, and you're long the dollar and you're long you're long the stock markets and you're long commodities and you're long bonds, and a macro environment comes along that just overnight everything just crashes in the opposite direction of the prevailing trend for whatever reason. Aliens invade, or some kind of like outlier thing that people aren't thinking about that's going to cause markets to go haywire. And it doesn't even have to be like real aliens invaded. It could be the perception that the aliens invaded that people thought was happening. It turned out to be fake news, could still cause this to happen. And I'm giving like an extreme, ridiculous example on purpose, where trend is only as effective as its ability to respond to changes in market directions. So in these kinds of environments where you have large, jump movements, no ability to respond to stuff, and you're coming from a very leveraged position that you can't like unwind, they're not going to produce crisis alpha. They're going to produce negative alpha during that kind of like event. So again, going back to I don't think that trend following strategies of any kind should be considered a hedge. They're not a hedge. They're not a reliable hedge, because in order for something to be an effective hedge, it needs to be something that you can rely on the correlation properties and the co-integration between the two asset classes to pay off. If it's sometimes it is and sometimes it isn't, then it may be a great source of diversification, but it is not a hedge. And so I just think that when I hear the word crisis alpha, I think a lot of people think hedge. It's always going to go up when the market goes down. And trend following is like, more often than not, that has been the case, but it is not a rule, and it's not something that should be relied on for a hedge. I just think it's an effective tool to diversify and add a non-correlated strategy into an otherwise diversified portfolio strategies. And it should not be the only strategy that you rely on in your portfolio. The same as I don't think bonds should be the sole source of diversification. Trend following should certainly not also be the sole source of diversification or defensive strategies in your portfolio. The best kind of defensive strategy is going to be something that uses multiple sources of defensive strategies that are uncorrelated equities and are also uncorrelated to each other. And so that you have kind of maximum diversity, and it's an airplane with 4 engines, not one.
Yeah, it's interesting you mentioned that. I think this year is clear proof that managed futures is not always going to be uncorrelated to equities when it matters the most. Now, interested in just to hear your thoughts. You mentioned 4 engines or a multi-pronged approach to kind of diversify against periods when equities are not working. What other strategies do you think could fit that bill?
Beyond trend following?
Yeah.
Gold is a great example of something that has had very low correlation to traditional assets, as well as bonds, as well as other alternative strategies. So if you just look at the return to correlation properties of gold over the long term, it's been a highly effective portfolio diversifier, that would have been useful. It's obviously more volatile than bonds, so you can't use as much of it as you would with bonds. But it can play a powerful diversity role. Like there are other asset class examples of that, and then those other alternative strategies that can perform or play a diversity kind of role. Long short equity strategies or merger arbitrage. Different categories of alternatives that may be of benefit or interest to investors in doing something that can produce a non-correlated source of return, but also be a source of diversification away from pure equities, and maybe a better alternative than than just being a pure fixed income investor.
You wrote the first version of this paper back in 2005, and then again you released this update with out of sample data from using returns from 2005 to 2024, which exhibits a slight decline in performance, and this is to be expected just with trend following. Generally, that's what it's done since the GFC. Do you believe that trend as a factor is experiencing decay? Is it experiencing capacity constraints, or is it just going through a rough patch? In other words, does trend following still work on stocks?
Well, we haven't seen any real material decay and trend following on stocks. I think that the biggest return in the last 10 years, at least in our case, because we have such a broad portfolio, there tends to be a bit of a small and mid cap tilt to the underlying holdings of what it is that we do. And there has been a well-known historic underperformance of small and mid cap stocks relative to large caps over the last 10 years. And that is more of kind of when you compare a diversified trend strategy on stocks that has had lower than average returns in the past 10 years, it's really due to the small mid cap performance drag or relative underperformance to large caps in the last 10 years. But then the previous 10 years, small caps outperform. So the relative performance of small and mid cap stocks has historically been like their cycles, right? Where it comes in and out of favor. That's been going on, a long time. This is an extended version of it. But that would be my answer to, I don't see any evidence that trend has had any, decay. I do see evidence that small and mid cap stocks have very much underperformed their large cap cousins over the last, decade. And there may be real structural reasons for that. That is a kind of a different conversation as it relates to investor flows into index funds and the impact that might be having on market efficiencies or lack thereof. Because the more people that you have index and more passive money is dominating a percentage of what's setting the market price, the less efficient markets will become. If everybody indexed, then there's actually no price discovery mechanism going on to set the correct value. It's really just all about investor flows that are passive, and nobody's even really thinking about that part of it. So to the tune of how much is that impacting, like you have had massive amounts of positive inflows that have gone into large caps and negative outflows from active small and mid cap managers, and you have far more money coming into large caps than you do in small and mid cap type things that I think are clearly creating a structural, kind of answer to why are these performance issues. They also then create inefficiencies or kind of relative valuation discounts that exist today as well. Whether or not they will get closed in the future, and that's a great investment opportunity, is a different argument. But I don't see any decay, with respect to the effectiveness of like trend following on stocks as an example. It's actually highly effective at making sure that you can cut losers out of the portfolio and just be very disciplined around owning less of the stocks that go on to be huge losers or be destructive drags on performance. And they're just as effective. A trend strategy is just as effective at putting you into the future winners as an index fund would do, because it's rules based. And that's one thing that index funds and trend have in common, is they're both very disciplined, rules based kind of approaches. With respect to multi-asset trend, currently right now, the industry as a whole, going back to maybe last 25 years of data since 2000, is in a max drawdown right now. So you've had the largest drawdown for the industry as a whole. So it's been a very rough time. That being said, the cycle that we had prior to that was also an incredibly above average period of time of some of the best trends. Like from COVID 2020 to 2022 is one of the best trending cycle markets that we've seen for a while. So that was like an outperformance period, and now you've gone to an underperformance period. In the last 10 years, the multi-asset trend category has not really produced very attractive rates of return. I think you're probably right around 2% is what the compounded annual growth was. Now, they also are very uncorrelated, and they have had their day in the sun, like 2022, where you had positive returns and produced crisis alpha and diversification. But the returns in the last 10 years have certainly been below average relative to what we've seen in previous years. Whether or not that is due to a decay in the effectiveness of the strategy or decay in the risk premiums that exist there, I would leave the answer to that question to people who specialize in multi-asset trend to answer, because our expertise and what we focus everything on in our systematic trend on individual stocks, which have not exhibited a decay in performance or a decay in the effectiveness or the outcomes or absolute performance that the multi-asset trend category kind of has. When you look at the performance, I think there are questions. My attitude towards it, though, is like I've heard the death of trend following. You can kind of go back and pretty much probably since the industry started, when every time it has a drawdown, it's over, it's never going to work again, and everybody gives up on it, and then it goes on to have some kind of streak of performance. So I would not bet against the resurgence of multi-asset trend delivering attractive investor returns kind of in the future, but the answer as to whether or not there's decay and why is there decay and the fundamental reasons for that, I would leave to people who specialize in that area to answer.
The last question I wanted to ask, how do you view the current landscape in investing? I know it's been a pretty volatile time. It's been a weird time this year. I feel like we've had sharp drawdowns, but we're still flat year to date. It was kind of like a mini COVID, but it really wasn't as hard as that. There's still some instability. Still, stocks are going up. International stocks are going up. What do you make of the current landscape, and what do you think is in store for the rest of the year?
I mean, look, the current landscape of news, or like the new administration coming in and having new policies that then have an impact on markets, and then or a reversal of those policies or a follow through of those policies. The market's response to that is sort of like a natural like thing. I think, in this case, there's been some, we're going to do something, we're not going to do something back and forth, which has created extra volatility. It's not the first time that we've seen, start stop decisions from leadership, either at the government level or in a company or in a family unit, create chaos. And we have seen that, and that play out in a form of volatility kind of in the stock market. But it's not surprising. That's just kind of a normal thing that would happen when you have start stop coming from any form of leadership or uncertainty. Or the markets don't like uncertainty, and so they react to uncertainty. I think it's just kind of a normal, factor. I mean, I got asked the question recently, like, is it different, than in the past? I'm like, I don't really see anything, that's the names and faces are different, but the markets are always going to be volatile. The markets are always going to react to things, and sometimes they underreact, sometimes they overreact. There's always going to be a news cycle, right? That's kind of trying to freak people out, and there's always going to be a volatility cycle. That's a natural order of occurrence in equity markets, and always has been, always will be. If equity markets weren't volatile, everybody would be rich, right? Because it would just be like, get in this thing that makes all this money and has no volatility. Well, that's not what the case is. And then nobody would buy bonds because, like, what, I can get a risk-free upside. Why would I buy? Why do I need to diversify? So I think that you're just going to continue to see more of the same unpredictable volatility and unpredictable boom bust cycles that play out. That over time, equities will go up and you'll be fine as a long-term, kind of investor, but there will be cycles of boom bust at the market level, and even bigger cycles of boom bust at the individual company or security level. And my kind of answer to that is, it's important to know your personal risk tolerance and like what you can handle emotionally as an investor. Some people, doesn't bother them, like all this volatility and up and down, it just doesn't matter, and they do not need any kind of active management or risk management strategies or defensive kinds of stuff. They just have a different risk appetite, and maybe they have a long duration. If you're a young investor and you have forever to kind of invest, then fall really doesn't matter to you. If you are wealthier and older in your cycle of stuff, your risk profile changes. You've worked hard, you want to preserve your money, you want to preserve your capital, you don't want to lose it and kind of screw up all this like lifetime of work. Well, then you do need defensive strategies, and you do need to build and engineer a portfolio that can survive and thrive through completely unpredictable future, environments. And I think that, whether it's trend following or other diversifying defensive strategies, you don't have to just rely on traditional stock market indexes and bonds as being your sole source of defense in this uncertain, unpredictable, future, especially in a world where, based upon where we're at in the debt cycle and other kinds of things. I mean, the potential and what's happening with the US dollar, that is not good for fixed income investors. So there's a whole new risk of being there was already risks of being overly dependent on fixed income as your risk diversifier. But now you're introducing a whole new cycle where there could be a massive currency risk associated with the value of the purchasing power and whatever on those things that you really have to think about over the next 10 to 20 year cycle of like how effective is fixed income going to be at maintaining purchasing power in a world where we have these debt crisis kind of problems or potentially facing us in the future. And I think you need a responsible financial advisor or investor would look at those things and say, maybe I need to add in additional sources of diversity and start kind of going down the list of what else could I do beyond bonds that could help me diversify my portfolio. Active strategies like trend following, gold, or a whole list of other things that are out there. I think investors who are maximally diversified in that way, beyond just relying on bonds, are probably going to get better outcomes, but most likely are not going to get worse outcomes than just relying on bonds standalone. So why not take the extra diversification?
Yeah, and I think that's completely right. We've since the 80s, it's kind of been the same very long-term trend of this kind of bond bull run. But even now, like you can see, I think there's a third kind of element at play here, where like before you would look at bonds and it's kind of like, hey, is inflation going up or down? And that would kind of dictate yields a lot. But you can kind of see it now in the long end, where yields are really starting to price in like maybe some default, like, hey, this is not looking good for sustainability. And I think that is now very much more prevalent today than it was, 10 years ago or 20 years ago. And that is, for fixed income investors, they really need to start thinking about what is something that could potentially diversify against that. Cole, I want to thank you for joining me today. Two things. Where can people find you? And are you working on any more research?
We are working on more research with Carlo from the Concretum Group about trend following, and maybe trend following on different sectors or different market cap, international markets, things like that. So I think hopefully later this year we'll be publishing more things or extensions of the previous work that we've done. Where to find us, we're mostly active on LinkedIn. So myself and other team members from Longboard are primarily use LinkedIn. And then our website at longboardfunds.com has a resource tab and content on it for research papers and other things that we're posting for people. I would say those are the two areas to find us at.
Cool. Yeah, viewers, check Longboard out, check Cole's LinkedIn. Again, make sure to read the paper. I'll link it down in the description. I want to thank you for watching. Make sure to also like and subscribe. If you want to check out our blog, go to alphaarchitect.com/subscribe, and there you can subscribe to the blog and find more educational content like this. Cole, hope you have a wonderful day. Thanks again for coming, and I'll see you next time.
Thank you. I appreciate it.